indeed a big step that the government has intended to take. Let's try and analyze what could it mean for the markets, what could it mean for the economy, and how you as an investor should be positioning your portfolios. Who better than Venugopal Garre, MD at Bernstein, joining in on the show to talk about exactly that. Venu, hi, morning. Good to have you on ET now. Venu, clearly the government seems to be pulling all strings, right? I mean, what more could have one asked for? Do you think it's finally going to propel consumption?
Thanks for having me on the show. Consumption has been one of the weak spots for the economy for quite a bit of a time, a couple of years now, with only some parts of consumption having potentially, I would say probably doing the heavy lifting over the last couple of years. So I guess the broader theme that the government has been working with in order to shore up consumption has been visible for almost a year. Started with some degree of subsidy push, followed by tax cuts for the middle class. And now we have this potential GST tax tweaks, which have been due for a while. It's been doing the rounds for a while, which could lead to some more of consumption transfer. In any case, the perspective is that taxation is fairly high in India if you were to combine both the indirect and the direct taxes. And this is a time where inflation is fairly low. So this is a good step to sort of lift up consumption of the lows, I would say. Remember that we are not calling this as a dramatic change in consumption trajectory, because those things happen only with economic strength rather than anything else.
But along with that, Venu, there will also be the fiscal impact, right? Do you think one must be cognizant of that?
I have been in a very different camp beginning of the year onwards, and I was a bit surprised when in the budget the government planned for a lower than expected fiscal deficit. So my thinking was, this is a time when the economy since second half of the year was weaker. There is no major advantage of trying to show a low fiscal deficit. You at least meet your fiscal deficit number, breach a bit, that's okay. A fiscal and a monetary push at a time when inflation is extremely low and the economy is not necessarily very strong is an ideal requirement, I would probably say. So you have to be very flexible on that. The second part of this is how much will be the fiscal deficit impact. It's anybody's guess, given that there are numerous variables that play around this. Firstly, we don't even know the full quantum of GST tax benefit to a consumer, because it's likely that certain higher value items or premium items could get pushed up, right, in terms of overall compensatory cess, etc. So we don't know, the eventual impact, but I would probably guess that it's going to be a positive transfer of at least a 10 billion plus to a consumer as a whole. Part of that can get neutralized by a lower capex, which is what I guess is my broader assumption. So your fiscal deficit perhaps is a 10 basis points sort of an impact. It could have been much higher if you don't really truncate capex. So that's the broad number. I would probably say it's more or less manageable in the overall scheme of things for this year.
But Venu, what would be the trickle-down effect? Because what's proposed is bringing the 4 GST slabs now down to 2, and GST on insurance premiums may also come down. Do you think the trickle-down effect will be more bottom-up, more FMCG, consumer goods, those categories will see a fillip?
Yeah, I guess the focus would be more on middle class, which is small value discretionary. And to an extent FMCG, so I would say FMCG is not like the major thing, but the point is small value discretionary is typically the most sensitive to price changes than purely an FMCG. But both are the categories that I would look at from a point of view of at least volume growth uplift and stock price movement. Higher value items, premium luxury goods, I guess is going to be probably out of this entire GST benefits in my view. We yet to see the fine print, but that's the way to play it at this juncture.
Right, Venu, hi, morning. So just on that note, how does one invest to make the most of this announcement that we've heard, you flagged off sectors like consumption, staples, durables, autos, but what should make it to our investors list in order to be able to take full advantage of this announcement that we've heard?
Yeah, so think of it as a 3-month sort of a story, because stock prices should ideally reflect that very quickly, and volume growth uplift should also be visible, in this festive season. So when it comes to consumer, there are various verticals. So FMCG is pretty much across the board, right? So you'll get some degree of positive movement across there. Investors can pick and choose their stocks, but FMCG overall across the board, maybe excluding some premium FMCG folks. In consumer durables, remember that quite a few items are already 18% sort of a GST rate. Things like air conditioners are in 28. So perhaps that could come down to 18, which is going to be positive for some of the air conditioning players. But durables overall, remember that there's an indirect benefit as well. If you're transferring in general some wealth to a consumer, it can eventually percolate into purchases of those products, even if their rates are not changing, right? So this is more a consumption buoyancy. So that's the second one I would probably argue. Remember, it's a consumer durable, is a range of players, but I'm just calling out air conditioners, given that they are the ones which might see a rate, trickle cut. The third chunk, primarily, I guess, is generic in terms of some spending towards the discretionary areas, especially retail or QSRs, which I've been selectively positive through the year because of other factors as well. Autos, not very clear as to what happens to the rates out there. Very, very tough to be very bold and take a call on that. But in a very theoretical construct, ideally, it should be small cars or small two-wheelers. So, stocks around those potentially are the ones to see a lift. But one can't be sure about that because it's not necessarily, considered as a day-to-day item.
Good morning. Thanks for that on explaining how to draw sector-specific patterns on the news and development. Big numbers coming. GST cut, which I expected to spark $13 billion consumption boost. But a food for thought. Will this GST-driven demand come at the cost of industrials and capex momentum? And are markets right in cheering consumption over capex? Could this shift hurt long-term growth according to you?
Yeah, so this $13-ish billion number is pulled out of calculations rather than based on any information. The idea was that if I were to theoretically assume tax rate slab changes, then probably this is a $20 billion sort of a number that comes out. Remember that the overall overarching GST number is $250 to $300 billion range. Now, the assumption was that, part of that essentially flows into consumption. So fiscal impact is different, while consumption impact is different because consumers may choose not to invest the gains that they get. So that's why this 13 billion was essentially 65% of the $20 billion number. Now, the point is, from a fiscal standpoint, government will have to neutralize something, either it is 10 or 15 or 20. And it cannot really come from any other area this year because I don't think direct tax collections are going to surprise you on the upside. So it has essentially to come from capex. And that's a number where you could potentially see some degree of a cut. Transportation capex is the one which sees probably the most impact. I would say defense capex will be a bit more rigid in terms of spending given the geopolitical requirements this year. But outside of that, most of government capex could essentially see some sluggishness. Whether private sector capex props up because of consumption volume increases, I would say those things don't happen in 12 months. And private sector has been fairly happy, sort of holding cash and doing buybacks, trying to improve ROEs rather than trying to do capex. So it's not going to really change materially this year. So overall capex environment might be a bit sluggish. So industrials underweight is a call. Utilities were equal weight. And as I mentioned, I'm a bit overweighted in consumption, which has been the call for this year.
Sure. Just a follow-up on that, this number that you're pegging in terms of the benefit to the economy, just want to understand that how much of this tax transfer that we've seen on the GST front could come back into spending and boost consumption the way the government wants it to, because the biggest leakage in this entire system is going to be household savings. Do you have any number or any estimate on that part, how much of it could trickle back into the system?
Yeah, in a very simplistic way, based on, as I mentioned, very theoretical numbers, because we still don't know some of these 28% tax rate items, how much it could go up to the 40% and above, right? So putting all this in a very bullish case, the argument was 20 billion is a transfer, of which 12-13 billion is essentially what consumers choose to buy products, which is basically the saving that comes into a consumer, and 13 billion dollars of additional products are purchased, right? Assuming no leverage, they're not leveraging that amount and buying, something of a larger value. So that's the amount. Remember, that builds up with the $15 billion of tax cuts, which were done from April. So that's like 15 plus 12. Think of it in a simplistic way, $30 billion of extra money sitting with the consumer. He can choose to invest in equity markets, or choose to buy products, or to, pay down debt. It's a combination of all that. But when there is so much money floating around, you would assume at least a significant part of that to come to consumption eventually. So that's the broad number. Remember, consumption numbers can, the headline consumption numbers in economy are more than $1 trillion, right? So we focus more on discretionary, which is probably, a third of that. So any lift that you see, a 30 billion on a third of $1 trillion, is a pretty large number in terms of volume growth.
Sure it is. But Venu, is it large enough for Nifty earnings expectations to move higher? I mean, from a market standpoint, what kind of returns are you anticipating for the second half of the fiscal year? Because, some of the triggers are also yet to play out, while, of course, the GST rejig is something that we're anticipating now. But even tax cuts, for instance, they're yet to trickle down. Even credit growth, expansion, that's also awaited.
Yeah, I mean, it's a very fair point. The reality is, as I was mentioning in the beginning, that this is not transformatory. Transformatory consumption boost, which happens organically because of economic strength, unfortunately is not the case this year. But remember that whatever is happening at this juncture is incrementally positive compared to what you would have thought a week back or a few months back. Economy had moderated significantly from 8% odd levels to 5%, and then has bounced back. Part of it is because of base effect as well. But in general, things have been fairly sluggish in the last 2-3 months. But this window of opportunity that India has with low inflation, with decent monsoons, food inflation being lower, this is the time when you have to do these measures to ensure that things don't deteriorate from here. So I would put it from that perspective. So if you're looking at a mid to high single digit earnings growth for Nifty, can it go to 15% just because of these measures? Of course not. Can it lift by 0.5% or a 1% number? Potentially, yes. But that's where we stand, at least as far as the next 6 to 12 months is concerned. Of course, we eventually would trend down to not a mid-teens, but some degree of 10 to 12% growth as we head to next year. So overarching framework is this, but if we don't do this right now, then economy could weaken further. And I think that's going to be a big challenge.
While you did touch base the monsoon factor, the seasonality factor, and while we talk about consumption, it's always the rural as versus the urban comparison, which we do. Will the GST cut change the outlook for rural consumption meaningfully? And going ahead, could this tilt more towards urban demand, widening the rural-urban divide?
That's a very interesting question, but a very complicated question, honestly. A lot of us don't even know the definition of rural as described by various corporates. It's all over the place. So let me put in a very simplistic way that this entire tax cuts, which are directed in middle class, is irrespective of whether they are in rural or urban. Doesn't matter. Rural positivity was more a theme because of lower base in terms of rural spending over the years, given that they were not really doing well, and we've essentially had 2 good monsoons now, and which is where growth rates in certain categories for rural is faster than urban. I don't think this entire GST changes the paradigm to look at rural versus urban. It's essentially for everyone. So I won't really say the call changes or the divide between an urban and rural really changes with what is happening at this juncture.
Right, okay. Venu, so good having you on the show. Thank you so much for